In this presentation, we will take a look at the internal rate of return, or the IRR. This is going to be our information scenario, being that we're going to be updating a piece of equipment. We're going to be starting out with a rate of 12%. This is going to be the required return on investment. We'll first calculate this with the required return on investment, in other words, a discount rate. And then we'll use the same data to calculate the internal rate of return so that we can give a compare and contrast of what the relationship is, what the internal rate of return is, and how it relates to basically an interest rate or a discount rate, or how it relates to the calculation of cash flows to the present value calculation. So here's going to be our scenario. If we fix the old equipment, it will last for 5 more years. The number of periods is going to be 5 years. Cost of the old equipment is $121,000. That's the cost. Cost to fix it is going to be $157,000. The annual expected revenues, $91,000. Annual cash operating costs, $37,000, and salvage, $22,000. So let's go through this one more time. We're going to be fixing the equipment. It then will last 5 more years. The old equipment has a cost of $121,000. Note, it's already on the books at $121,000. That's a sunk cost because we're making the decision from here forward. So this is actually irrelevant basically to our data as of our decision-making process now as to what's going to be the payoff of what we do now going forward. So what we want then is the cost to fix. It's going to cost us $157,000 to fix it. And then we want to compare the cash flows that will result from that fixing. The cash flows being $91,000 expected revenues, and the operating costs $37,000. So that's going to be the cash flows. 91 minus the 37 is what we're going to be returning for 5 years after we put down the initial payment of the $157,000. Then we have salvage value of $22,000, meaning that at the end of 5 years, we're going to be able to just scrap our equipment, sell it for what it is, and get back $22,000, the salvage value. So given that information, we'll put that information first calculating with the 12%, and then we'll take a look at what it means to have the IRR. So if we took the years 0 through 5, the cost, I'm going to break it out by cost first. That's going to be the $157,000. That's total $157,000. Then the cash flows being, of course, the $91,000 minus the $37,000, or the $54,000. $54,000 each of those 5 years, adding up to a total cash flow of $270,000 net. And then we have the salvage value only happening in the last year, $22,000 total, $22,000. If we sum this across, then the $57,000 pulls over the $54,000, and then the $54,000 and the 22 is the $76,000. Then we can present value each of these years. The first year, of course, is what it is. $157,000 is $157,000 at year 0. The $54,000, if we pull back to year 0, present value, 48 to 14. The next 54, 43,048. The next 54, if we pull back to year 0, 38,436. The next 54, 34,318. And finally, the $76,000 total, if we pull it all the way back to year 0, 43,124. If we sum these up, then if we add up the present value, 50,141. So in other words, total cash flow, $135,000 positive. The net present value, or the net present value, is going to be the 50,141. That is discounted at the 12%. So we used 12%, and we're thinking 12% because it says it's going to be the return that's required. That's going to be kind of like a hurdle rate, the rate that we have to clear in order to accept a project. So that's the minimum rate we'd have to clear. Any number then over here that's positive is going to be something that we can accept because it would have cleared then the 12%. If it turned out to be negative, then it would be something we would reject because it had not cleared that 12%. Now, what's going to be the internal rate of return? What we'll do is say, okay, what if we got rid of that 12%? And now we think about what rate it should be or needs to be in order for this present value cash flow to be 0. We want this $50,000 to be 0, and then we're looking for that internal rate of return that will do that. That's in theory what the internal rate of return is. So it's easy to conceptualize in theory like that, and you can say, and you could start to say, well, that could be a useful number. It could be a useful number for us to compare the internal rate of return, the return at which the cash flows would be zero if we're comparing multiple projects. So the calculation, however, if we were to do it by hand, is a bit complex. Usually you're not required to do that by hand. If you were to do it in Excel, it's really easy to do because there's actually a function to calculate the present value. So we can use the present value function, or we can use a goal seek type function. We can basically just keep changing this percentage up top, right, until this gets to be zero and we get pretty close to our number. Or we can use goal seek for Excel to do that method, or we can use a function, and we'll do that in Excel when we see this problem in Excel. So we'll also work this in Excel and we'll go through that calculation. So if we just use the internal rate of return function within Excel, we get 2363. So again, that's going to be the present value that we're going to need in order for this cash flow to calculate to result in a zero balance. So again, conceptually, we can see what this number is now with this comparison, the present value calculated at 12%, and then us seeing what we need, what that percent needs to be, 2363, to get a result of zero. Again, normally in a book problem, we don't typically have to calculate that because it is a bit more complex to do by hand. We can do it pretty easily by trial and error, and we can use Excel to format or get to this calculation very easily as well. So it's useful in practice.